Good morning. It's Nancy from Nancy Chu Homes at Keller Williams and J Metro Group. It is Tuesday morning, March 14th, and it's been like 24 hours of kind of like stress in my house because um, my husband Raf and I have been sort of sitting around waiting to see what the CPI numbers are that got released today. So I wanted to take 2 seconds out of the day and just have a conversation with you guys. All right. So first, let's roll it back a little to last Friday. Last Friday, we had the a bank failure, Silicon Valley Bank, which is, I believe, the second largest bank failure that we've had since the one that happened. I remember Washington Mutual was during the recession. So the U.S. banking system is under a lot of stress. Biden came out and was like, "It's going to be fine. Have faith." It was pretty intense. Okay, and so there's been a little bit of stress. Now, my personal belief is that if you sort of follow the chain of events of how SVB came to failure, um, it seemed like a lot of self-sabotaging. Like I don't really understand what happened, you know. So let's talk a little bit about this because, okay, so Signature Bank, Silicon Valley Bank, these are all sort of, they're sort of regional mid-sized regional banks. And right now, First Republic out in California, which does a lot of commercial lending, they're taking a bit of a tumble. Their stock prices went down by like 60%. And before the stock market rallied this morning, a lot of the big banks were kind of taking a small 4% to 6% hit on their values. Okay. So let's talk a little bit about what Silicon Valley Bank was. So, for instance, this is a bank that, it's where venture capitalists go to bank. And the thing that I thought was interesting is that when the interest rates were very low, these banks all grabbed a ton of treasuries and bonds. And now that the interest rate has like gone pooh, then these bonds are down, and these banks are now they were now sitting on these losses. Okay, and what they did was they sold off, 21 billion worth of these, assets, and they sort of fell, just under 2 billion short. And in the end, I don't know why they did this, but the CEO came out and was like, "We're short 2 billion," which is like the weirdest thing. I don't really understand why he did that. It seemed like 2 billion in large scale banking terms isn't that much money. Like I feel like he could have, actually filled in the gap before, and instead he announced it and kind of set off like, a It's a Wonderful Lifestyle run on the bank, right? Mary, let's go get our money from the bank. And it was like, oh my God. And when you've got, very powerful and influential venture capitalists, Tyrell, um, pulling their money from the banks, it kind of set this like, I don't know, what did it do? It set like the Telegram world on fire, and all the VC guys were all like on Telegram together going, "We should pull our money," and they just like wrecked the bank. I don't know. It's super bizarre. I'm not even sure how to make of it, but that's kind of what happened, right? So everybody slow your roll, all right? And let's look and see. If the Fed chooses, right, if the Fed chooses to increase rates again at, a significant pace, then I think that they're definitely putting the banking system under even more stress. If the Fed slows down and takes a little breather, I think that, we can kind of all slow down and collect our thoughts and, stay with it. There were some, but the Fed kind of, we're all kind of hanging around waiting to see what the CPI numbers were today and the PPI numbers tomorrow. Okay. So the CPI numbers today, and I'll show you a chart. Here we go. Have a look. Okay. So the anticipation and what it kind of needs to stay around was that, headline CPI needs to have a month-on-month increase of, 0.4%, and a year-over-year increase of 6% to stay kind of with projections, right? So core CPI would be the same, 0.4% month over month and 5.5% for year over year. That was what is expected, and kind of like, it just really can't be much more than expected. That's kind of what freaks everybody out, and that's kind of what happened in January, okay? So the CPI is high. The Feds are going to feel like they have to raise the rates, right? But that puts a lot of pressure on these mid-sized regional banks. It really puts them in the danger zone. Okay. So these are the numbers that we kind of have to stick around. Now, I'm going to give a little segment of my opinion here, all right? And that is, I would love for the Fed to just take a big chill pill, because one of the challenges we had when the CPI numbers came out, and here's a chart, okay? So have a look at this chart. CPI numbers came out pretty accurately to what we had hoped for, with the exception of, as you can see, the housing did not go down. As you can see, every single little colorful bar here shrunk except for housing. And housing apparently accounts for about 70% of the increase that we're seeing. So, and that would be about, not only purchases, but also, rents, etc. Now, please understand that the housing portion of this particular, index is based off of the Bureau of Labor Statistics asking. They're literally just asking people, right? It's based on a survey. And everybody knows, Alan Reynolds is always complaining about this. Everybody knows that their statistics and this survey is like 6 months behind. Okay. It's a 6-month minimum lag time. So I'm like, please, everything else is going down. If we have a 6-month lag on, possibly the housing portion of these numbers, then the Fed should just chill, stop raising rates, and just take a breather and let housing finally catch up so that we can actually see what the result is of this massive front loading of interest rates. I mean, and I don't have a nice way to say it. That's like what I'm calling it, this massive front loading of interest rates. Like, I'm already struggling enough with the fact that the Fed behaves off of 40, 50-year-old data, right? So in other words, the last time we had this type of inflationary experience was in the 1970s. Are we really going off of the experience from 40 to 50 years ago? I'm just trying to figure out what else we do now that is reflected off of something 40 or 50 years ago. I mean, I would assume technology and other things have sort of brought us past that kind of thinking. So what is the Fed other than a bunch of like very old men who remember the 70s and are functioning off of data from 40 to 50 years ago? Okay. They front loaded all these massive interest rates. Okay. Can we wait to see whether or not the medicine is working before we continue to administer medicine that both cures and also poisons us at the same time? I'm just saying. Okay, guys, listen. At this point, my instinct, and I think other people have been sort of, this has been bandied about, which is, these numbers are not horrific. They are kind of right in line with what we thought. So I'm hoping that the Fed decides that their next interest rate, which I believe they're meeting in about 10 days, 10 to 14 days, like the 24th or something of March. I've got my fingers crossed that instead of, doing a big significant raise, maybe they'll just do like a 25-point basis raise, which I think we can survive, as opposed to hitting us with something, 50, 70 basis points, 50, 75 basis points. Let's go 25, 25, 25, or maybe just hold steady and let the housing numbers catch up. Not that anybody's listening to, this rando person, talking on YouTube, but that would be my hope. All right, guys. If there's any new information when the PPI numbers are released tomorrow, I will jump on and just, and say something. But otherwise, I think this is kind of where we're at. All right. At least the Dow rallied this morning. Okay. I'll talk to you guys soon. All right. Oh, by the way, if you like our videos, please don't forget to like and subscribe and comment. Thanks.